This is not financial advice, and I am not a financial advisor.
This is just me talking about my personal financial journey. This is for entertainment purposes only.
Enjoy the show.
So imagine two master explorers, right? And they're trying to map the exact same, incredibly dense, impenetrable jungle.
Okay, I'm picturing it.
Right. So one of them is just, well, he's down in the mud. He's got this magnifying glass. He's looking at footprints, studying the broken twigs, really trying to understand the actual animals that live down there.
Right, very hands-on.
Exactly. But the other explorer is, he's up in space. He's using a satellite to track, thermal fluctuations in the canopy. He's completely ignoring the animals on the ground.
Oh, wow. So totally different paradigms.
Completely. But here's the thing. They both ultimately find the hidden city of gold. It's just that the maps they draw to get there look entirely fundamentally different.
That's a great analogy.
Thanks. And that is exactly what happened when two of the greatest financial geniuses in history beat Wall Street. I mean, we're asking a big question today for this deep dive. What happens when two masters beat the exact same system, achieve historic, legendary financial returns, but do so using completely opposite versions of reality?
It's really a phenomenal paradox because usually in any competitive field, the truth of how to win eventually converges.
Right, like sports or something.
Yeah, exactly. Or chess.
Yeah?
The best chess players eventually start playing the exact same optimal openings. But here we are looking at a scenario where the ultimate winners operated in completely different universes.
Yeah.
On one side, you have the belief that markets are made of people, and therefore, deeply understanding people and businesses is the key.
Makes sense.
But then on the other side, you have the belief that human behavior is just chaotic noise, and the only truth, the only thing that matters, lies in the underlying mathematical structure of the universe.
Okay, let's unpack this. We are looking at the immense friction between the fundamental qualitative analysis of Peter Lynch and the quantitative mathematical modeling of Jim Simons.
Two absolute titans of finance.
Right. And they looked at the exact same market and saw two entirely different things. And to really understand how they pulled this off, I think we have to start with the raw materials.
Right.
We have to look at what these two men actually considered to be data, because their differing philosophies completely changed their definitions of the word. Let's look at Peter Lynch first.
Well, for Peter Lynch, who, ran the Magellan Fund at Fidelity Data, was all about signals.
Okay, signal.
Yeah. And a signal to Lynch was deeply rooted in business reality. He practiced fundamental analysis.
Which, if you've been following equity markets, you definitely know this approach.
Exactly. I mean, he wasn't just looking at a ticker symbol moving up and down. He was dissecting the balance sheet. He was hunting for mid-cap value equities with, low price-to-earnings ratios.
Usually hidden in incredibly boring industries, right?
Oh, yeah. The more boring, the better. So data, for him, was a company's debt-to-equity ratio, its inventory turnover, its market share growth.
So for him, data was really the narrative of the business itself.
Very much so. Lynch was famous for looking at the story behind the numbers. He wanted to know the why.
Right. Motivation.
Yeah. If a company's stock was rising, he wanted to know, well, did they hire a visionary new management team? Or are they quietly dominating some niche market that Wall Street is just completely ignoring?
Yeah, he believed that if you understood the fundamentals better than anyone else, the stock price would eventually reflect that reality.
Exactly. The story was the signal.
And I think, for you listening, we all naturally default to that way of thinking. Think about your own retirement portfolio or when you read the financial news.
Right, it's how we're wired.
Yeah, when you look at an Apple or a Tesla, you are probably trying to guess what the next product launch will look like. You are trying to figure out the story.
You're acting like Peter Lynch.
Exactly. But then you look at Jim Simons, the founder of Renaissance Technologies, and he flips that entirely on its head. Simons looked strictly for what traditional analysts like Lynch would just discard as noise.
And this requires a massive, just a huge paradigm shift to fully grasp. Jim Simons was a mathematician. He didn't care about the corporate balance sheet. He don't care who the CEO was or what their forward guidance looked like. In fact, his team often didn't even know the names of the companies they were trading.
Wait, really? They didn't know the names?
Nope. They were just looking at strings of characters. To Simons, all of those human stories that Lynch considered vital signals were fundamentally irrelevant.
Which kind of begs the question, if you are completely ignoring the company, what on earth are you actually analyzing?
You are analyzing the absolute chaos of millisecond price fluctuations.
Just the raw movement.
Exactly. Simons was hunting for predictable mathematical sequences buried inside all that noise. His team used complex probabilistic models, things like hidden Markov models.
Oh, I've heard of those. They use those in speech recognition, right?
Yeah, exactly. To predict the next word you're going to say. But Simons used them to predict the next micro movement of a stock price.
Okay, I want to make sure I'm really visualizing this. It's like Lynch is a detective reading a suspect's diary to understand their motives.
I like that.
Right. He's reading the words, he's interpreting the emotion, tracking the plot. But Simons is like a forensic scientist analyzing the chemical makeup of the ink on the page.
Yes.
He is completely ignoring the words. He doesn't care about the confession. He just cares about the predictable rate at which the ink dries.
That analogy hits the absolute core of the divergence. What's fascinating here is that these aren't merely different trading strategies. They represent fundamentally different worldviews.
How so?
Well, Lynch assumes that human rationality and actual product value ultimately drive outcomes, right?
Right.
Simons's worldview assumes that human actions in the market are largely random, chaotic, and driven by short-term emotion. But, and this is the key beneath that chaos, universal math governs the movement of capital.
So you view financial markets the same way a physicist views weather patterns.
Exactly. Pure physics.
Well, if your entire worldview is that market narratives are a distraction, then the last person you want to hire to run your fund is a storyteller, which completely upends who you actually bring into the building to do the work.
Right, because when your philosophy relies on understanding businesses, you hire MBAs.
Right.
You bring in people who can tear apart a cash flow statement, who understand supply chain logistics, who know the players in the industry. You hire Wall Street veterans.
But Simons explicitly banned Wall Street experts from his team.
He did.
The sources point out he literally would not hire them. Instead, he hired astrophysicists, he hired string theorists, he hired cryptanalysts who used to break codes for the National Security Agency.
It's wild.
And I'll be honest, I'm stuck on this point. Here's where it gets really interesting because I'm struggling with the logic.
Yeah.
If you were managing billions of dollars of capital, how is it not fiduciary suicide to hand the keys over to a guy who studies black holes instead of balance sheets?
Well, it sounds reckless until you look at the mechanics of what they were building. If we connect this to the bigger picture, if Simons hired a brilliant MBA, that analyst would bring their fundamental biases into the system.
Oh, I see.
They would bring Lynch's signals into Simons' search for pure noise.
Wait, let me make sure I'm tracking this. How does market knowledge actually hurt the math? Wouldn't an MBA be able to, I don't know, optimize the algorithm by adding context?
No, because the MBA is looking for causality, and the algorithm is only looking for correlation.
Okay, give me an example.
Let's say an algorithm flags a massive buy order for a specific stock, because historically, whenever this obscure combination of volume and price movement happens, the stock bounces up a fraction of a percent 3 seconds later.
Right, pure correlation.
Exactly. But an MBA might look at that ticker and say, stop the trade. The CEO just resigned in a massive accounting scandal. The company is doomed.
So the human stops the machine because the human knows the story.
But to the algorithm, the scandal doesn't matter at all. The math has detected a temporary pricing inefficiency that will correct itself in 3 seconds.
Wow.
If you let the human override the machine based on a narrative, you contaminate the system. You introduce emotional bias into a purely statistical model.
That is wild. They weren't trading companies at all. They were literally treating the stock market like an encrypted Russian communication tape from the Cold War.
Exactly.
They were code-breaking human chaos.
They were looking at an endless stream of ones and zeros, knowing that like 99% of it was random static, but they used massive computing power to find the 1% that repeated. Let's break down the actual mechanism for a second, a concept called statistical arbitrage.
Yes. Let's get into the how. How did it actually work?
So statistical arbitrage is essentially betting that two things that historically moved together have temporarily drifted apart.
Okay.
Say historically, two rival automotive stocks move in tandem. Suddenly, for no logical reason, one drops a fraction of a percent while the other stays flat.
Right.
Simon's algorithm would instantly buy the cheaper one and short the expensive one, knowing the math dictates they will eventually snap back together. They didn't need to know why the gap opened. They just needed to execute the trade before the gap closed.
And they are doing this millions of times a day, making microscopic profits on each trade.
Yep, millions of times.
So we have these two entirely opposite paradigms. Lynch mastering the fundamental human element, and Simons mastering the pure mathematical element. And the crazy thing is, They both achieved legendary success.
Unbelievable success.
Yeah, I mean, Lynch's Magellan Fund averaged roughly a 29% annual return over his tenure. That is unheard of.
It really is.
And Simon's Medallion Fund blew even that out of the water, generating average annual returns over 60% before fees.
Just staggering numbers.
But despite having totally different definitions of data and entirely different talent pools, that immense success forced both of them into the exact same structural trap.
Because the physics of money eventually catch up to everyone.
Right.
Whether you are trading on fundamental stories or quantitative math, there is a structural limit to how much capital you can deploy before you break the very system you are trying to exploit.
On Wall Street, this is known as the penalty of size. Let's look at how this broke Peter Lynch's model first.
The penalty of size is a fascinating mechanical problem. When Peter Lynch took over the Magellan Fund in 1977, he had about $18 million under management.
Which is pretty small in the grand scheme of things.
Very small. And because the fund was relatively small, he could hunt for those hidden gems. He could find a solid, mid-cap industrial company with a $100 million valuation, take a meaningful position in it, and when that stock doubled, his fund's overall returns skyrocketed. His alpha, his edge over the market was huge.
Because he was nimble. He could slip in and out of these boring, unglamorous stocks without anyone noticing.
Precisely. But by 1990, because his returns were so staggering, Magellan had grown to $14 billion.
Wow. From 18 million to 14 billion.
And at 14 billion, the mechanics completely change. If Lynch wanted to generate alpha, he couldn't invest in a $100 million company anymore.
Why not?
Because to move the needle on a $14 billion portfolio, he would have to buy the entire company, which turns him from an investor into an owner.
He becomes the whale in a very small pond.
Exactly. The moment he tries to take a $500 million position in a mid-cap stock, his own buying pressure drives the price of the stock through the roof before he's even finished acquiring his shares.
Wow, okay.
The act of buying destroys the value he was trying to capture.
He is literally artificially inflating his own purchase price.
Yes. So he is forced to abandon the small hidden gems. He is forced to park billions of dollars in massive global large cap companies just because they have the sheer volume to absorb his cash.
That's ironic.
His success literally eliminated his ability to maneuver. The human scale maxed out.
Success built a cage around him. Now, if your strategy requires mathematical precision rather than fundamental narratives, how does size impact you? Because Simons recognized this exact same scaling problem, but his solution was completely different.
Completely different.
He actively avoided the penalty of size by deliberately capping the Medallion Fund's total assets.
And this is a crucial difference in the underlying mechanics of quantitative trading. Simons' algorithms operate within incredibly strict liquidity limits. Remember, his astrophysicists and cryptanalysts were finding millisecond anomalies.
Right, tiny little blips.
They are trying to extract a fraction of a cent out of the spread between the bid and the ask price.
And to make that fraction of a cent meaningful, you have to trade massive volume.
Exactly. But for every trade, there has to be someone on the other side. That is liquidity, the depth of the order book. If the Medallion Fund had $100 billion trying to squeeze through a microsecond window, the market simply wouldn't have enough sellers to absorb that capital.
The spread would just vanish.
Yep. The sheer weight of Simons' money would warp the price data, destroying the mathematical pattern the algorithm was trying to exploit.
So what did he do?
He did something virtually unprecedented in asset management. He kicked his outside investors out.
Just gave them their money back.
Just returned their capital and capped the fund. Depending on the era, they kept the assets under management hovering around the $10 billion mark. Any massive profit they made above that cap was distributed out as cash to the employees every single year.
Oh, wow.
They had to drain the pool to keep the fund size perfectly optimized for the algorithms.
It's totally brilliant. If we go back to our earlier metaphors, it's like Lynch built this rugged off-road vehicle. It was amazing at finding hidden paths, but over time, it got loaded down with so much cargo, so much capital and success that it became too heavy for the dirt trails.
It got bogged down.
Right. It was forced onto the main highway, whereas Simons built a highly tuned Formula One car. It is unfathomably fast, but it can only operate on a perfectly paved, highly specific track. If you make the car any heavier, the suspension breaks and it crashes into the wall.
Both paradigms have immense power, but both have absolute physical limits based on the mechanics of scale.
Okay, so if scale is the ceiling they both hit, what happens when the floor falls out? Because the modern market we live in today is heavily algorithmic and incredibly fast, but it is also deeply volatile.
Very true. And this forces us to examine the core vulnerability of Simon's pure math, a concept known in quantitative finance as regime change.
Regime change. When I hear that, I think of geopolitical revolutions. How does it apply to an algorithm?
Well, it's a fundamental shift in the underlying conditions of the market. Algorithms are entirely built on historical data.
Right.
Even when they are hunting for noise, they are finding noise that has a historical precedent. They rely on the assumption that the future will, statistically, resemble the past.
Okay, give me an example.
Think about correlations. Historically, when equities drop, bond prices often rise as investors seek safety. Quants build entire models around that correlation.
But what happens when an unprecedented event occurs? Something that has literally never happened before in human history, and therefore has absolutely no mathematical sequence to rely on.
That is the Achilles heel of the quantitative model. Think of a sudden, unprecedented global pandemic, or a completely unexpected land war that instantly disrupts global energy supplies.
Things we see recently, yeah.
Exactly. When human beings collectively panic in a novel way, the market enters an entirely new regime. The old rules no longer apply. Equities and bonds might suddenly crash at the exact same time. The statistical correlations that held true for 20 years just evaporate overnight.
So what does this all mean? I want to push on that, because this feels like the crux of the whole debate. When the market goes into an unprecedented free fall, does the math just break? Can a cryptanalyst algorithm ever truly predict a completely irrational human panic?
This raises an important question, and the answer is, in moments of true, unprecedented regime change, the models often fail.
Really? Yeah.
Yeah, sometimes the algorithms just freeze because the data parameters are so far outside of standard deviations that the system literally doesn't know how to act.
It just shuts down.
Or, other times, which is worse, the algorithms actually accelerate the panic because they lack the context to understand why the numbers are moving. And this is exactly where Peter Lynch's qualitative fundamental approach regains its massive structural advantage.
Because humans understand context.
We understand the why. An algorithm struggles to parse the nuance of an unprecedented global lockdown. It just sees volatility metrics spiking. But human intuition can instantly contextualize it.
Right.
A fundamental analyst can watch a news broadcast about a novel virus, look at supply chains, and instantly deduce, okay, people are going to be locked in their homes for months. They are going to buy massive amounts of home office equipment and cloud computing subscriptions and zero commercial airline tickets.
So the human can read the new story of the world way before the math has had enough time to catch up and form a reliable new pattern.
Exactly. Fundamental analysis can bridge the gap of the unprecedented. It can operate in the void of historical data, relying on logic, empathy, and an understanding of human nature. The quantitative algorithms are incredibly powerful, they are ruthlessly efficient, but they are ultimately blind to meaning.
That is a profound realization. We've covered some serious ground today. For you listening, we've seen how two brilliant minds conquered the exact same domain using fundamentally opposing forces.
Yeah, it's a great story.
We've looked at the mechanics of how Peter Lynch analyzed the human story of a business and how Jim Simons treated the market like encrypted static. We've seen that whether you are hunting for vital signals or decoding the noise, both paths have incredible power. But they're both bound by the strict physics of scale and unpredictability.
And as we look toward the future, the sources leave us with a truly provocative thought to consider.
Oh, I like the sound of that.
We are currently witnessing the rapid advancement of artificial intelligence. And I don't just mean language models, I mean AI systems that can bridge the gap between qualitative language and quantitative math.
A system that can do both.
Right. Are we witnessing the birth of a third paradigm? What happens if an AI eventually learns to map the exact mathematics of human irrationality?
Wow.
What if it can take Lynch's fundamental understanding of human behavior, the fear, the greed, the contextual nuance of a global event, and seamlessly translate that directly into Simon's predictable statistical sequences?
That's kind of terrifying.
If a machine can perfectly quantify the messiness of human emotion, will our financial markets finally become perfectly predictable, or will they become infinitely, unmanageably chaotic?
Quantifying the messiness of human emotion, that is an incredible thought to leave off on. If the two explorers from our opening metaphor, the one with the magnifying glass and the one with the satellite, suddenly had their minds merged to one single super explorer, what kind of map would they draw?
Thank you for joining us on this deep dive. Keep questioning the world around you and keep looking for the signals and the noise in your own life.